And welcome back to another episode of Sipping Wealth Live, where I bring you and tricks on how to wealth up. Ooh, make sure everything's okay. Okay. That was a little glitch in there. Hello, everyone. So today I will be talking and speaking about the differences between the Roth account and the traditional retirement accounts. So that as you continue to save over the past few weeks, I've been making sure that I segment out a section to go over retirement and the different things that it that is within the retirement realm, so that we can make sure that we cover all facets and we have a better understanding, or at least most of the more common facets, and have a better understanding of retirement and the accounts and what we should do next. All right, y'all. So I am going to hop into it. Let me make sure we are good on the platforms. Okay. And okay. Right. So I am going to hop right in it so that those of you that are tuning in and afterwards can just get the important information. Um, Per usual, make sure that you are sharing and hitting the subscribe button on the YouTube channel, Sipping Wealth, and also giving some feedback as to whether or not this information is helpful, whether or not it's actually insightful and it's helping with your financial and wealth journey. All right. Hey, Sam. Hey, hey, hey. Thanks for tuning in. Okay. Let's get it done. Okay, so for starters, I'm gonna kind of speak on. I'm gonna start on what is the Roth versus the traditional accounts, and then we're gonna go over the tax treatments. The tax treatments is what's gonna tell, what's gonna determine the differences between your traditional retirement accounts versus your Roth retirement accounts. All right, so you can have your Roth 401k or your Roth IRA. IRAs are stands for individual retirement account. Your 401k is generally going to be with an employer, or if you're a business owner, you can set up your own 401k within the business entity. But generally, there is a business or employee kind of situation when you have a 401k involved, versus an IRA, which is an individual retirement account that you go ahead and set up on your own or with the financial advisor or investment advisor to go ahead and get it done. Hey, Wadleen, let's talk about this money. Yes, Denver, absolutely. Let's get this money. Give me my money. No. Okay, for starters, tax treatment. So with the traditional retirement account, we have where it is pre-tax dollars. So you're not going to pay taxes on this money when you put the money in, but when you're withdrawing the money at retirement time, you are going to pay taxes then. So generally, the benefits of having a traditional retirement account is that it's reducing your tax bill during the years that you're contributing to the retirement account, because it is not being taxed at that time. It's just being taxed when you are pulling it out at retirement. Why would somebody choose a traditional account? And I'm a huge believer in having both. All right. But, we're just going to kind of break them down right now. Why would somebody choose a traditional account? To ensure, hey, maybe it's a year where their income, they're a high income earner, and at retirement, their income's probably maybe going to drop or be at a fixed income amount. So, and they project this. So they're saying, hey, I'm at a high income year. Let me go ahead and contribute. Let me max out my contribution on my retirement account to make sure I am, like I said, maxed out on there. So I have that retirement savings when it comes to, retirement age or time to actually distribute the funds. Now, a Roth retirement account is going to be, you're going to be taxed now versus later. So this is post tax dollars. This is dollars that are taxed as soon as you contribute to the retirement account. Meaning, so you're still, when you file your taxes, there's no tax advantage at that time, but when you go to pull out the money at retirement time, that money is no longer taxed. So the key benefits to having a Roth account, and this is why there's a lot of, which I'm going to go over during the live, there's a lot of different caps and limitations when it comes to contributing to the Roth retirement account. And this is why, because you do have your key benefits, which is a tax-free growth and tax-free withdrawals during retirement, which a lot of people want to take advantage of this Roth account. So depending on your income, which I'm going to go over, but depending on your income amount, it's going to prevent you from being able to directly contribute to your Roth account. So there is a way to still contribute into your Roth account, which I will go over briefly. If you do, of course, per usual, if you want more information, be sure to reach out or book a call, all that good stuff, okay? But like I said, people generally want to contribute to the Roth account because it has that tax-free growth along with that tax-free withdrawal during retirement. All right. So the income limits we're contributing to a Roth, a traditional account versus a Roth. So with a traditional account, there is no income limit for contributing. It doesn't matter if you make 500K a year, $1 million a year, $10 million a year, $50,000 for the year. You do not have an income limitation when it comes to contributing to your traditional IRA or accounts. All right. Hello, hello. To contributing to your traditional retirement account. With your Roth account, you do have a limitation. So these are restrictions, and this is direct contributions to your Roth account. So if you are a single filer or married filing separately, your limitation is $153,000. All right. So your restriction as far as you being able to put money directly into the Roth account is at an annual gross income limit of $153,000. So once you reach a gross income for the year of that 153,000 and you are a single filer, then you do hit that limitation. Now, my married folk or my joint filers, it's $228,000. Now, generally every year it does, limitations kind of shift a little bit. We can even see some changes as we go into this new election and new tax. There can be some changes as well, but generally it's like a slight increase, a slight bump, but there is a limitation. So you can expect that. All right. And then let me know if you have any questions as I'm going through this. Okay. So the next thing I want to go over is the required minimum distribution. So RMDs. So RMDs is saying, hey, if you do not start withdrawing this money by this age, we are going to penalize you. Yes, the IRS does penalize you if you don't start withdrawing your money out of your retirement account by a certain age. And for your traditional accounts, your traditional retirement accounts, it's at age 73. Okay. And that's as of 2023. Okay. So like I said, some changes can still be made, but as of 2023, the age is 73 RMD, which is the required minimum distribution age. Okay. So and also to reiterate, if you do not take the money, start distributing from your retirement account, the traditional retirement account, then you can be faced with penalties. All right, the next, as it relates to RMDs with your Roth account, your Roth doesn't actually have any RMDs. All right, there's no retirement required minimum distribution for a Roth account. So this means if you do have a Roth retirement account, not only is your money at tax-free growth, tax-free withdrawals, but you could continue to grow your money tax-free indefinitely, like without the requirement of having to pull the money out of their account. So how do people get 5 million, $10 million in their, how do these big income earners get all this money in their Roth account? Well, there is something we kind of like to call like a back door, Roth conversion. And that's just making sure that, hey, I may go ahead and convert some money from my traditional retirement account into my Roth account. So even though you can't directly contribute funds to your Roth account, like from your bank account to your Roth, you can convert some money from your traditional retirement account and roll it over into your Roth account, which is a great advantage. And with that Roth account, if you do a self-directed retirement account, IRA, you self-direct, you invest that money into, whatever item that you are knowledgeable in, any thing that you are knowledgeable in. If you invest in that with your Roth account and you 10x, 20x, 5x that money in your Roth account, and that, like I said, tax-free growth along as well as tax-free withdrawal. So that is the beauty of having a Roth account. I recommend having both, definitely needing both. If you are a business owner, making sure that you do take the advantage of setting up a retirement account with your business. If you do need assistance with this, feel free to reach out. I do have some colleagues that I work with that are great with this. Make sure that you take advantage of that, being able to take the write-off of contributing to your retirement, being able to, by having it in your business, as well as, hey, I have savings for my retirement. And if it's a Roth, now you have that tax-free growth, tax-free withdrawal. Bop, bop, bop. All right. So early withdrawal rules. So for those of you, um, great information. Thank you. Thank you. So, early withdrawal. So, if you do go in before retirement age and start withdrawing money out of your retirement accounts, there is a penalty. So, for your traditional retirement accounts, the age is 59 and a half. So, if you go in before the age of 59 and a half, you are subject to an additional 10% penalty. So, like I said, this is a traditional account, which means, hey, when you pull that money out, you will have to pay income tax on that money. So along with paying income tax on that money, you are now subject to a 10% penalty. So if your tax bill is, say, 22%, Don, would love to network with you, Miss Charles. I'm in the insurance space. Absolutely. Yeah, sure thing. Absolutely. Um, yes, yes. Okay, so if you are, I gotta get back on track, yo. Early withdrawal. So, um, if you are at that 22% income tax rate, and on top of that, like I said, it's a traditional account. Now you're getting hit with a 10% penalty for the early withdrawal. So now you're looking at 30% of that money being taxed. So if it was $100,000, 32% of $100,000 need to be paid to the IRS for the income tax bill for that money. And that's for the income tax as well as a 10% penalty. All right. So now you are paying $32,000. I've had clients that come to me and they're like, hey, I took a withdrawal, and it always happens after the fact. Hey, I took a withdrawal out of my retirement and the IRS says I owe this amount of money. Yeah, because you did an early withdrawal and and it's a traditional retirement account, which means you have to pay income tax on it when you withdraw the money. Okay, so you do want to make sure that you are aware of that before you go withdrawing your retirement funds ahead of time. All right, now there are some exceptions that can qualify for, like the first time home buyer. Now only a portion of it, and I believe it's like $10,000. if you withdraw $10,000 out of your traditional retirement account to purchase your first home, then they're like, you don't have to worry about that 10% penalty. But if you withdraw $100,000 out of that account to purchase that home, no, only $10,000 of it is going to be excused from the 10% penalty. All right, disability, things like that, hardship, not hardship, medical expenses. There are a few things that are where exceptions apply, but it's usually a portion of it, or you have to meet certain stipulations and parameters. All right, so make sure that you are aware of that. All right, don't get caught up with the 10%. It gets hefty. All right, that for your Roth retirement accounts, for your Roth IRA, your contributions can be withdrawn at any time, um, uh, since they were already taxed. Because this is money, like I said, that's already taxed. The contributions can be withdrawn. Now, the earnings that as far as the Roth that made can be taxed, can be hit with that 10% penalty. Okay, if it's withdrawn by the age of 59 and a half. All right, so the earnings are subject to the 10% penalty. The contributions can be withdrawn. So if you contribute $5,000 to your Roth IRA and the money goes up to $20,000, you can only withdraw $5,000 because that's what you contributed to the Roth account. Now, if you go and pull $15,000 from it, the rest of that money is going to be subject to a 10% penalty if it's withdrawn before the age of 59 and a half. All right, let me make sure. Okay. All right, cool. Let's go. Okay. So, eligibility for contributions for your traditional IRA accounts. You can continue to make contributions, regardless of your income amount until the age of 73. And this is for tax deduction purposes. All right. So this is for those that are contributing to their traditional account, retirement account, so that you will still be charged your regular income tax amount. All right. So it doesn't excuse you from the income tax if you continue to contribute. For your Roth account, you can continue to contribute to your Roth account regardless of your age. You can do it. Flexibility. So with your traditional retirement account, IRA account, there is less flexibility with that account as far as your required minimum distributions and your inheritance, as far as your beneficiaries and everything. But there is more flexibility as it comes to your inheritance and your required minimum distribution because with your Roth, because on the Roth accounts, there is no required RMD. And then there is more flexibility with your Roth account when it comes to building out your estate plan and your beneficiaries and the whole inheritance package. Okay. Now your contribution limits for 2024 for these accounts, and I'm going to leave off here. Your contribution limits for both your traditional and your Roth account for 2024 is going to be $6,500 per year if you're under the age of 50. Now, if you are over the age of 50 years old, you can contribute up to $7,500, an extra $1,000 towards your Roth or your traditional account. Now, this doesn't mean that you put $6,500 in your Roth account and then another $6,500 in your traditional. All right, no, it's just like I'm gonna contribute into my traditional account. And then for our 401ks, they're a bit different, but generally the contribution limit for your 401k as an employee on the employee side, without like the extra employer contribution and all that, is going to be $23,000 per year under the age of 50, and then $30,500 if you're older, over the age of 50 years old. All right, and that's for your 401k plans. Right. So that I know that is quite a bit of information as far as, making sure that you understand the difference between the Roth and the traditional account, but it's necessary information. All right. So some things to consider when you're contributing or creating these Roth or traditional retirement accounts is consider your tax bracket. All right. So if you're in a higher tax bracket, determine whether or not this is the year that you want to do a Roth contribution versus a traditional contribution or vice versa. And then what the tax implications may be. All right. And then making sure that you have a diversification as far as your retirement accounts. All right. You want to make sure that I highly recommend having both a traditional and a Roth account. All right. So, and then making sure that you, figure out what you want to invest those funds into. If you're just doing a general fund or if you're doing a self-directed account where you can invest in some other assets, that's going to generate a larger return possibly. All right. The next is to make sure that you are starting as early as possible in contributing to your Roth account, and your retirement account overall. Okay. It is absolutely crucial that you start as early as possible because this allows your money time to grow. All right. And especially if you're doing like a Roth contributions and you anticipate being at a higher tax bracket later on, then you want to contribute as much as possible. And when you're at a lower income amount, because it could be hard, it's a bit more difficult to contribute directly to your Roth account as your income grows. All right. And then the next is to look at your current and future income. I know I kind of alluded to that in the last tip, but making sure that you're actually projecting what your future income looks like. And then make sure that you are avoiding those extra penalties and fees when as it relates to the retirement accounts, whether it's the early withdrawal penalty or it's the RMD penalty. Backdoor Roth. So if your backdoor Roth, like I explained early on, works, then utilize that. Okay. Just get that money in there, grow that money so that you can have the retirement that you envision for yourself. If the employer is matching on your Roth or your 401k account, take advantage of that free money. And then with the rest of the money, you can invest it in your own IRA account or your own Roth IRA account. But for at least if your employer is like, hey, we matched the first 4%, then contribute up to that 4%. And then you can do whatever you want with the rest of the money invested in your personal IRA account. All right. So those are some tips that I wanted to make sure I share with you all outside of just giving you some information on the differences between the Roth and the traditional accounts. I hope this was helpful for you all. Give me some feedback. Comment in the comment section, whatever the case may be. And if you need assistance, be sure to reach out to us as strategic tax accountants. We'll be happy to assist, as well as checking out our blog posting on the site, and making sure that you subscribe to the YouTube channel. So, as usual, thank you for joining me for another episode of Sipping Wealth Live, giving you news, tips, and tricks on how to wealth up. All right, y'all. Have a great night and an amazing Tuesday.